In this video, I'm going to give you several tips on how to trade fair value gaps. And if you stick all the way to the end, I'm going to give you a free fair value gap checklist that will help you choose the right ones in your own trading. So what is a fair value gap? Whether you call it an imbalance, whether you call it an inefficiency or a fair value gap, it all represents the same thing, some sort of imbalance in the market. Now this is printed with a 3 candlestick pattern. For an example, in a downwards direction, we can see the first bearish candle here actually printed a nice candle body, but we did have this wick on the bottom side, right? So the next candle opens up, has a pop up, and then we have another decline past the previous candle's low. Once this candle actually closes lower than the previous candle's low, we now create a gap, okay? So we have a gap from this low down to this candle body's close. So now what we need to see is for price to swing back up and retest the missing price between this candle's low and this candle body's low. But what we can see on this third candle is that we actually do not make it all the way back up to this point here. So this leaves what's called a fair value gap or an inefficiency. This area needs to be filled in, and many times it's a magnet price. So now we want to see a retest into this range and then another expansion to the downside. Now let's check out this bullish example. We have the first candle print here, we have the candle body close, and then we also have the highest point of the candle, which is the wick. We can see the second candle expands past the previous candle's high. This once again leaves a gap between the first candle's high and the second candle's close. So all the pressure is now on the third candle to fill in this range. And we can see that once again, it does not fill it in, which means that price has printed a fair value gap between these two levels. So once again, the first candle's highest point, which is the wick, and the third candle's lowest point or price, which is the wick. So once we close this 3 candlestick pattern, we can anticipate for price to come back into our fair value gap, fill it in, and then expand from it. Now, although I gave you the basic understanding, hold on 1 minute because we're about to go to live examples. Here we have an example of a buy side imbalance or a fair value gap. We can see we had our first candle close here with the highest wick point being here. We can then see the second candle open up and expand past the first candle's high, closing up here. Now all the pressure is on the third candle to make this range move efficiently. And as we can see, the lowest price point did not close in the full range, which means we now have a fair value gap that price needs to rebalance in before expanding higher. And as we can see on this next bearish candle, it actually rates the low of that third candle, which enters the fair value gap. And then we have another candle that gaps a little bit lower within the range, but then overall expands out of it. This rejection is the power of a fair value gap. Now let's take it a step deeper. If you were to overlay a Fibonacci with all the levels taken off except the 50% over the fair value gap level, what you can notice is when price retested the 50% and maintains above it, if you're looking for a buy, this is a lot of times the strongest reaction and rejection from a fair value gap, meaning you can anticipate a very large move to happen with little to no issue. Now let's use that same concept on this impulse where we had a bearish fair value gap. We had another bearish fair value gap down here. We'll also break down this impulse right after, and then I have a surprise for you guys. So why did this fair value gap not work out while this one actually did? It's actually quite simple. In smart money concepts, the premium and discount range is one of the most important things to understand. Meaning if I'm looking for a sell in the market, I only want to sell it above the premium range, which is the 50% or higher of the last impulse. Vice versa for a buy. So in this scenario, this sell side imbalance or fair value gap was too low. It was already in discount, meaning that I would only want to buy from this level up to premium. So this would not be a tradable fair value gap. So now let's look at this fair value gap and how it reacted. As we just talked about, we can also place a Fibonacci just over the actual fair value gap, and this will let us know how strong a fair value gap actually is. So overall, we still want to see this maintained no matter what, but if we see the 50% level maintained, then that is letting us know that this is going to be a very strong reaction with little to no hesitation in the range. But what we can see here is as soon as we retested into it, we actually wicked to the top of this fair value gap. Then we played around in this range for a few more candles before actually getting the impulse. So it still maintained the fair value gap, but it played around a lot more because we passed that 50% level. So where would you place your stop on this? Ideally, what you want to do is use the same logic that you did on this impulse leg within this fair value gap. So if I'm looking for a sell, I want to look to sell in the premium of this fair value gap. And then I want to place my stop loss above the candle that created the fair value gap. In this case, we had 1, 2, and 3 candles. So the second candle is going to be the one that I want to place my stop loss above. Then from that point, I want to target the next level of liquidity. In this case, this low, which gives me an easy 1 to 3.15 risk to reward. And with our stop loss only being 6.5 points, these little wicks popping up isn't really that bad. Let's now move to this second example. We have a sell side imbalance here, and we also have another one here. Then lastly, we have another one here. What do we do in a scenario where we have so many in one impulse leg? Well, first off, we eliminate all the ones we can using the premium and discount. In this scenario, this larger sell side imbalance or fair value gap at the bottom gets deleted. Next, we only have these two fair value gaps left. One tip that I use is simply just waiting for price to actually reach the first fair value gap. Many times what you'll see is that price will easily either reject it, forming a nice wick that you can enter off of, or just expanding directly through it and closing higher, which also gives you a little bit better of an entry if you wanted to wait for it. Now, the pro to that is, like I said, you get a better entry sometimes, but the cons to that is sometimes price will reverse so quickly you end up getting a worse entry. So how do we mitigate? Well, the easiest way to do that is simply by understanding as long as you're above premium, you already are in the best pricing that you can get for this next impulse out of it. So what I mean by that is you can take the trade off of the lowest fair value gap if you're looking for a sell, and placing your stop loss above the swing point. This allows you to be in the market no matter how high it goes. And as long as you place your stop loss above the swing, it doesn't matter if price chooses to go a little bit higher before reversing back in your direction. In this scenario, the market still gave you a 1 to 2.5 risk to reward before consolidating a bit and then reversing. And guess what happened before price had a huge expansion? A buy side fair value gap. If you like instant access to our completely free fair value gap cheat sheet, simply click the link in the description and we'll get it over to you ASAP.